3 weeks ago, my phone rang. I almost didn't pick up. Didn't recognize the number. Probably spam, I thought. But something made me answer, and what happened in the next 60 seconds is the entire reason you're watching this video today. The man on the other end, I haven't spoken to him in over a decade. He's not a journalist, not a YouTuber, not selling anything. He spent years buried deep inside the United States financial system. Not on the outside looking in, but on the inside. The kind of person who sat in rooms where real decisions about money get made. The kind of person who understands how financial stress actually builds, long before the public ever hears about it. He didn't say hello, no small talk, no, how have you been? The very first words out of his mouth were a question. How much cash do you have outside the banking system? Right now? I told him the number. The line went quiet. Not the kind of quiet where someone is thinking about what to say next. The kind of quiet that feels like the air just left the room. Then slowly, calmly, he spoke again. You should probably double it before April. Why April specifically? In a moment, I'll explain exactly what is converging in the financial system between now and then. And once you understand it, that warning will make complete sense. When someone with that kind of experience says something like that, you don't ignore it. You don't brush it off as paranoia. You ask why. What struck me most wasn't what he said. It was how he said it. No panic, no drama, just quiet certainty. And in my experience, that is the most dangerous kind of warning there is. Hi, I'm Rasmus. Before I got into financial education, I spent years in banking and investment research, studying how financial systems behave under stress, how institutions manage risk, and what happens when the two collide. I've seen financial crises build slowly and break suddenly. I know what the warning signs look like, and I know how rarely ordinary people get told the truth about them. That's what Rule by Seniors exists for. Real information, delivered straight. For people who worked hard their entire lives to build real wealth and now need to protect it. After that phone call, I spent weeks going back through the data. Bank balance sheets, government debt numbers, credit markets, commercial real estate, looking for what my source was pointing at. And here's what I found. The risks building inside the financial system today don't look dramatic on the surface. The stock market is near historic highs. Everything appears stable. But financial stress never begins where everyone is looking. It starts quietly, in the plumbing. Here's exactly what we're covering today. What really happened in 2023, and why the same pressure still exists. The commercial real estate problem hiding inside regional banks right now. Why April matters. And what's actually converging in the financial calendar. 3 warning signals professionals watch before a financial storm. And a specific 3-step protection plan with real numbers, built for retirees. This is not a doom video. This is not about fear. This is about preparation. And there is a massive difference between those two things. Let's get into it. And stay with me until part 5. The numbers I'm going to give you there are specific, and they could change how you think about your money permanently. To understand what my source was warning about, we need to go back. March 2023. Most people remember the headlines. A major bank collapsed almost overnight. Regulators stepped in over a weekend. Within days, the story faded from the front pages, and the takeaway most Americans walked away with was simple. One bank failed. Government stepped in. Problem solved. Move on. But here's the thing. That is not what actually happened. That bank didn't collapse because of fraud. It didn't collapse because of reckless lending and the way we saw in 2008. It collapsed because of something far more basic, far more widespread, and far more relevant to what's building in the system right now. Here's the 90-second version. This is the part most financial channels skipped. For years, when interest rates were near zero, banks across the country bought enormous amounts of long-term government bonds. Safe investments, standard practice, nothing unusual. Then the Federal Reserve raised interest rates at the fastest pace in more than 4 decades. And here's what most people don't know about bonds. When interest rates go up, the value of existing bonds goes down. Think about it like this. If you're holding a bond that pays 2% interest and someone else can now buy a brand new bond paying 5%, why would anyone pay full price for yours? They wouldn't. So your bond loses value immediately. Suddenly, banks were sitting on massive paper losses in their bond portfolios. Hundreds of billions of dollars across the system. Unrealized, but real. Now, normally that's not an immediate crisis. Banks can hold those bonds to maturity and receive their full value back. The loss only becomes real if they're forced to sell early. Unless their depositors start pulling money out. Because the moment large withdrawals start, the bank must sell those bonds at the lower market price to raise cash. In roughly 48 hours, using mobile apps and online transfers, depositors moved billions of dollars out. Modern technology turned what might once have been a slow, manageable problem into a crisis that developed faster than anyone could stop. And here's the part that really matters. Official banking data showed that financial institutions across the United States were collectively sitting on hundreds of billions of dollars in unrealized bond losses. Not just the one bank that failed. The problem was widespread. It was just invisible until it wasn't. Think of it like a pressure point hiding inside a wall. You can't see it. It doesn't cause problems until something forces it open. That pressure point is still there today. But bonds aren't the only stress point. What I found next actually surprised me more. Commercial real estate. Now I know that phrase sounds abstract. Let me make it very concrete. Over the past few years, the way people work changed permanently. Remote work, hybrid schedules, millions of employees who simply never went back to the office full time. In cities like San Francisco, Chicago, and New York, office vacancy rates have climbed to levels that would have seemed almost unimaginable a decade ago. Entire floors sit completely empty. In some districts, nearly 1 in 4 office spaces is unoccupied. Empty space means less rent. Less rent means the building is worth less. A building worth less creates a serious problem for the bank that holds the loan on it. Here's where it gets important for you specifically. Many of those commercial buildings were purchased or refinanced during years when interest rates were extremely low. Owners took out large loans expecting stable rental income and manageable borrowing costs. Today, that math looks completely different. Higher interest rates make refinancing far more expensive. Lower demand for office space means some buildings simply can't generate enough income to cover their debt. Over the next 18 months, a very large number of commercial real estate loans will hit their maturity dates. Owners must either refinance or repay. If the numbers don't work, defaults happen. And here's the detail most people miss. The majority of these loans aren't held by the biggest global banks. They're held by regional and mid-sized banks. The same institutions already carrying those unrealized bond losses we just discussed. 2 pressure points, same banks, at the same time. Now, I want to be clear, this doesn't mean a wave of bank failures is guaranteed. Financial systems are complex. Regulators are watching, the largest banks are well capitalized. But for retirees who hold significant deposits at smaller regional institutions, this is exactly the kind of slow-building risk that rarely gets attention until it suddenly becomes a headline. And speaking of things that don't get enough attention, let's talk about why April specifically matters. This is what my source was pointing at. By the way, if you're finding this valuable, hit subscribe right now. And what's coming in the next 2 chapters is the most practical part of this video, and you don't want to miss it. Here's the answer to the question I've been holding since the start of this video. Why April? 3 specific things converge in the early months of this year that financial professionals have been quietly watching. First, commercial real estate loan maturities are heavily concentrated in Q1 and Q2. This is the period when many of those loans we just discussed will be forced to refinance at today's higher rates. The stress doesn't build slowly, it arrives on a schedule. Second, the U.S. Treasury faces a massive refinancing wall in the first half of the year. Hundreds of billions in short-term government debt rolling over, competing directly with private borrowers for the same pool of capital. Borrowing costs go up. Liquidity gets tighter. Third, The Federal Reserve's quantitative tightening continues through this window. The process of removing liquidity from the financial system keeps draining the reservoir. The lower it gets, the less cushion exists when stress appears elsewhere. Now you understand why someone who spent years inside this system said, double it before April. Not because April 1st means catastrophe, but because the combination of pressures peaking in that window represents the tightest financial environment we've seen in years. Right now, the United States government pays over $1 trillion every single year, just in interest on money it already borrowed. Not paying down the debt, just the interest. That means the government spends more on interest payments than on many of its largest programs combined. When the government borrows this much, it competes with everyone else for capital. Banks, pension funds, businesses, everyone is fishing in the same pool. And when the government is the biggest fish, everyone else gets crowded out. Borrowing costs rise, liquidity tightens, and the financial system, which depends on stable funding and predictable conditions, starts to feel pressure from every direction at once. And here's the biggest mistake 90% of retirees are making right now. Most retirees assume that because their money is sitting in a bank account, it is automatically safe, no matter what happens. It probably is. But probably is doing a lot of work in that sentence. FDIC insurance protects deposits up to $250,000 per depositor per bank. If you have more than that at a single institution, or if you have zero liquidity outside your long-term investments, you are taking on a risk that almost no one has told you about. Now, let's talk about what to actually watch for, and then what to actually do. Experienced financial professionals don't predict the future. They watch pressure gauges. When enough gauges move in the same direction at the same time, it tells you the system is approaching a stress point. Here are the three most important ones, and where each stands right now. The first is the 10-year U.S. Treasury yield. This is the interest rate investors demand to lend money to the U.S. government for 10 years. When it rises sharply, it pushes up mortgage rates, corporate borrowing costs, and deepens bank bond losses. Right now, after a significant climb from historic lows, the 10-year yield remains elevated at levels that would have seemed extraordinary just a few years ago. Every basis point higher means deeper unrealized losses in bank bond portfolios and more expensive refinancing across the economy. The second is regional bank stock prices. Regional banks are more exposed to commercial real estate and local lending than the biggest global institutions. Their stock prices act as an early warning signal, declining months before broader problems become public. The regional banking sector has significantly underperformed the broader market since the 2023 events. Investors are still pricing in elevated risk. That sustained discount is not irrational. It reflects real concerns about the two pressure points we've already discussed. The third is corporate credit spreads, the gap between what safe companies pay to borrow versus what risky companies pay. In stable environments, this gap stays narrow. When stress builds, it widens, meaning lenders are becoming cautious and liquidity is tightening. Right now, credit spreads have been relatively contained, which is actually the most important thing to watch. Historically, when multiple stress factors are building but spreads remain calm, it creates a false sense of security. When they finally move there, they tend to move fast. None of these signals alone means crisis. But when you combine elevated bond losses, commercial real estate stress, a tight liquidity environment, and a concentrated pressure window in early 2025, you get exactly the kind of environment where individual preparation makes an enormous difference. All right, everything we've just covered means nothing unless we talk about what you can actually do. The goal is not panic, not to withdraw everything from your bank tomorrow morning. The goal is financial resilience, the ability to remain calm, flexible, and in control regardless of what happens in the broader economy. 3 steps, specific numbers, let's go. Step 1. Build your liquidity buffer. The single most powerful thing a retiree can do right now is maintain money that is easily accessible without depending on the stability of markets or any single financial institution. The guideline most conservative financial planners recommend is 3 to 6 months of living expenses. held in accessible, stable forms, outside your long-term investments. Here are the real numbers. If your household spends $4,000 per month, your buffer should be $12,000 to $24,000. If you spend $6,000 per month, $18,000 to $36,000. If you spend $8,000 per month, $24,000 to $48,000. If you spend $10,000 per month, $30,000 to $60,000. Where do you hold it? Some people keep a portion as physical cash stored securely at home. Immediate access, no system dependency. Others prefer Treasury bills purchased directly through treasurydirect.gov, backed by the U.S. government directly, not an individual bank. Some retirees also hold a small portion in gold or silver, assets that have historically held value during periods of financial stress. Why does this work? If markets drop or a bank temporarily restricts withdrawals, your immediate life is completely unaffected. You have time to wait, to think, to decide from a position of calm rather than panic. Step 2. Review and fix your FDIC coverage today. The FDIC insures deposits up to $250,000 per depositor per bank. This protection is real and has worked for decades. But the key phrase is per depositor per bank. Here is what this actually means, and most sources get this wrong. Individual accounts are insured up to $250,000 per person per bank. Joint accounts are insured at $250,000 per co-owner, meaning a couple's joint account is insured up to $500,000. Retirement accounts like IRAs are insured separately up to $250,000. The result, a married couple can protect up to $1,000 at a single bank through proper account structuring. That is the joint account at $500,000, plus the husband's individual account at $250,000, plus the wife's individual account at $250,000. The simple fix: log into each bank account you hold, add up your total deposits at each institution, and if any institution holds uninsured excess, open a second account elsewhere and move it. Properly structure joint versus individual versus retirement accounts to maximize your coverage. This takes 30 minutes and adds a layer of protection most retirees never set up. Step 3. Rebalance your portfolio for the rate environment that actually exists today. This is the step most financial channels get wrong. They say diversify into bonds without telling you this. In a high-rate environment, long-duration bonds lose value. The same dynamic that created unrealized losses inside bank portfolios applies to your personal investments too. Standard bond advice from a low-rate era does not apply today. Here is what a retiree portfolio should look like right now. 40 to 50% in broad equity index funds for long-term growth. 15 to 20% in short-term bonds or treasury bills only, 1 to 2 year duration maximum. 10 to 15% in cash equivalents like money market funds, CDs, or short-term T-bills. 10 to 15% in inflation-resistant assets like TIPS, real assets, or commodities. And 5 to 10% as your liquidity buffer from step 1, held outside this portfolio entirely. Short-term instruments let you reinvest at higher rates as they mature. Long-term bonds lock you in at lower rates and lose market value if rates stay elevated. The environment changed. Your allocation should reflect that. Those 3 steps don't require a financial advisor. They don't require predicting the future. They require one thing: intentional structure. A financial life built to handle uncertainty, not one that assumes conditions will remain perfect indefinitely. I want to tell you about 2 people. Both retired, both in their late 60s. Both had built meaningful savings over a lifetime of work. When they retired, they each had approximately $380,000 in total assets. Names and specific details are illustrative, based on real patterns seen across retirement planning cases. When a period of market volatility hit, they experienced it completely differently. Margaret had done everything she was told. Her savings were fully invested. Market portfolio, bank accounts, long-term bonds. She trusted the system completely. When markets dropped 22% over several months, her portfolio fell to approximately $296,000 on paper. But that wasn't the real problem. The real problem was that Margaret needed $4,800 every month to cover her living expenses, and she had almost no liquid savings outside her investments. She was forced to sell at the worst possible moment, at prices she never would have chosen. Over 8 months, she sold roughly $38,000 in investments at depressed values just to cover her expenses. By the time markets recovered, Margaret had locked in approximately $11,000 in permanent losses. Not because the market failed her, but because she had no runway. She had no buffer, no time, no choice. David had done something different. Not complicated, not dramatic. Before markets turned, David had set aside 6 months of living expenses, $28,800, in a combination of treasury bills and a separate savings account outside his main investment portfolio. When the same market volatility hit, David did nothing. His $4,800 monthly expenses were covered by his liquidity buffer. His portfolio stayed intact. He didn't sell a single share. He simply waited. When markets recovered, David's portfolio was fully intact. He had lost nothing permanently. He had, in fact, used a small portion of his buffer to buy additional shares at the lower prices. His preparation cost him 30 minutes and the discipline to set aside $28,800. His return on that preparation, approximately $47,000 more in final portfolio value compared to Margaret. The difference between Margaret and David was not intelligence. It was not luck. It was not timing. It was $28,800 set aside in the right place before the storm arrived. That choice is available to anyone watching this video right now. 3 weeks ago, a man called me out of nowhere. He didn't say hello. He asked one question, and then he gave me a warning. Double it before April. After that call, I called him back. I told him what I'd found in the data. The bond losses, the commercial real estate pressure, the government debt window, the liquidity drain. He listened, and then he said something that stayed with me. The people who are going to be fine aren't the ones who predicted it. They're the ones who already built something that didn't need them to. That is the entire message of this video. Financial security is rarely about predicting the future perfectly. It's about being positioned well enough that whatever the future brings, you remain steady, in control, with options. You do not need to know exactly what happens next. You need a structure that can handle what happens next. And the best time to build that structure was before you needed it. Here is what I want you to do in the next 48 hours. 1. Review your deposits at every bank you hold. Confirm you're within FDIC limits and that your accounts are properly structured. 2. Calculate 3 to 6 months of your living expenses and start building that liquidity buffer this week. 3. Look at your portfolio bond exposure, specifically your duration, short-term only in this rate environment. 3 actions, 48 hours. It may be the most valuable financial work you do this year. And if this video gave you even one thing to think about, here's what I'm asking in return. Hit the like button right now. 1 second. It tells us this kind of content matters, and it helps us reach more retirees who need to hear it. If you are not yet subscribed to Rule by Seniors, hit subscribe and the bell. We publish real, practical, no-nonsense financial content regularly. And next week, we're covering exactly how to read your bank's financial health report in under 10 minutes. Most people don't know this document even exists. You'll want to see it. Please share this video with a spouse, a sibling, a friend approaching retirement. One conversation at the right time can make an enormous difference in someone's financial life. The best time to prepare was yesterday. The second best time is right now. I'm Rasmus. Thank you for watching Rule by Seniors. Stay sharp, stay prepared. I'll see you in the next one.